All right, let's just jump right in and completely dismantle a massive societal obsession. We all know that number we silently judge each other by, right? The one you might subtly hint at on a dating profile without actually saying it out loud. Your salary. We've been taught to treat it as the absolute ultimate metric of success. But what if I told you that metric is a total illusion? To understand why, let's look at our core mystery. On one side, we have Mark. He is earning a massive $145,000 a year, but his actual built-up wealth is sitting firmly at zero. And right next to him is Carla, taking home exactly half of that, $72,000. Yet, fast forward 10 years, and Carla is the one who can walk away from work forever, while Mark is still grinding away. How on earth is that mathematically possible? Well, the truth is, salary is a terrible measuring stick for wealth, because keeping the money is the entire game. Your salary only tells you how much money flows towards you. It says absolutely nothing about how much actually stays. And it turns out staying is the only part that actually buys your freedom. So instead of obsessing over salary, we really need a roadmap built on the 3 real numbers that quietly decide your future. These are the digits that silently determine whether you get to retire at 55 or if you're stuck at a desk until you're 75. Let's break down the actual math, starting with the first one. Pillar 1 is the only number that tells you the honest truth about your financial foundation, your net worth. Forget salary. This isn't just some boring accounting term. This is your actual, undeniable financial scoreboard. The beauty of net worth is just how brutally simple the formula is. It's literally just everything you own minus everything you owe. And this perfectly reveals why Mark, despite his huge income, is really struggling. Between his leased German sedan, credit card debt, and a closet full of depreciating items, if you do the honest subtraction, his net worth is hovering right around zero. He is a high-income person with a fundamentally low-income balance sheet. It just goes to show how people constantly confuse looking rich with actually being rich. It basically boils down to this. Your salary is a rumor, but your net worth is the receipt. The loudest lifestyles usually have the emptiest scoreboards, while the quietest are often the most undeniably free. Take Diana's story, for example. She's managed to build up $18,000 in assets, which is great, but she carries $30,000 in high-interest debts. That 24% interest credit card debt reaches directly into her scoreboard and drags her net worth down while she sleeps. You simply cannot build a secure financial future on a foundation that's actively sinking. And if we pull the actual Federal Reserve data, you'll see a pretty sobering reality across all age brackets. From people under 35 all the way up to those in their 60s, the typical household is sitting on far less wealth than their paychecks would suggest. Literally, millions of dollars flow through our hands over a working lifetime, but only a tiny, modest pile actually sticks around. But you have to avoid the trap Maya fell into. Maya did the really hard part. She saved $100,000 in cash. That's huge. But saving isn't the finish line. Money that is not invested is a scoreboard number that stands completely still. Until it's put to work in the market, inflation is just quietly eating its purchasing power from the inside out. Which perfectly tees up Pillar 2, your savings rate. If net worth tells you exactly where you are, your savings rate is the exact speed you are driving. And let me be super clear about this. This is unquestionably the most powerful number in this entire explainer. A high savings rate is actually a massive double win. Sure, it's just the percentage of your take-home pay that you keep instead of spend. But when you increase this fraction, it attacks the problem from both directions. It means you stash more money away for tomorrow while simultaneously proving you need less money to live on today. This leads us right to the shockingly simple math of early retirement. If you save just 10% of your income, you still have roughly 51 working years ahead of you. But push that to 25% and it drops to 32 years. Hit a 50% savings rate and you're done in 17 years. Every single extra chunk you save actively removes decades from the far end of your working life. Let's bring back our 2 examples to see this in action. Because Carla aggressively controls her spending, she maintains a 35% savings rate. So financial freedom arrives in her late 40s. Meanwhile, Mark saves a measly 5% of his massive income. Mark is going to be working a 40-year grind, clocking into the office long after Carla has been retired for a decade. Now, to put this into perspective, the average American personal savings rate right now hovers around a really dangerous 4 to 5%. Mathematically, a 5% rate practically guarantees a working career that stretches past half a century. And it's largely thanks to lifestyle inflation, where every raise you get just quietly gets absorbed by a slightly fancier lifestyle. And that brings us to our final pillar, your FI number, or financial independence number. This is the ultimate metric. It turns vague, general financial anxiety into a concrete finish line you can actually chase down and eventually cross. Based on the famous 4% rule of market history, finding your FI number is incredibly simple. It's just your annual expenses multiplied by 25. This sneaky, beautiful metric doesn't care at all what you earn. It only cares what your life costs. Once your invested net worth hits this number, you can historically withdraw 4% a year, adjust for inflation, and theoretically never run out of money. So, because Carla's lifestyle is super lean at just $45,000 a year, she is playing a much, much easier game. Multiply that by 25, and her finish line is incredibly attainable. She only needs about $1.1 million to be completely 100% free. Meanwhile, Mark's massive lifestyle inflation means he's burning through $130,000 a year. Multiply his expenses by 25, and his finish line has been pushed back to a staggering $3.25 million. He literally has to save nearly 3 times as much as Carla, on a savings rate a fraction of the size. It's a race he is mathematically losing. Knowing these 3 numbers, where you are, how fast you're moving, and exactly where the finish line is, writes your financial script entirely in advance. Because, let's be real, what happens when disaster strikes? Let's say a sudden recession hits tomorrow. Let's say both Mark and Carla get laid off in the exact same week. Because Mark has huge fixed costs and absolutely zero financial cushion, a layoff is a total catastrophe for him. He's got about 3 weeks of pure panic runway. Carla's solid numbers, however, turned that exact same layoff into a patient, year-long sabbatical where she can just kick back and wait for the perfect next opportunity. This right here is exactly why earning more money is actually a silent test. Converting a raise into more lifestyle just puts you on a faster treadmill. You end up running harder toward a finish line that's actively running away from you. But converting that raise into savings, that means you are quite literally buying back years of your own life. At the end of the day, your salary is simply what the world pays you. Your savings rate is what you pay yourself. The world will always try to sell you the lifestyle that eats up your salary, constantly urging you to measure success by the size of your paycheck. But your 3 numbers, they will always keep an honest score. So, here is your action plan. I challenge you. Grab a pencil, take 10 quiet minutes this Sunday, and calculate these exact numbers for yourself. Step 1. Add up your net worth to find your honest starting point. Step 2. Divide your savings by your take-home pay to find your speed. And Step 3. Multiply your annual expenses by 25 to locate your finish line. The next time someone tries to tell you the secret to wealth is just earning a bigger salary or getting that flashy promotion, ignore the noise. Look at your own scoreboard, make the decision that matches your reality, and ask yourself this single, life-changing question. What is your savings rate?